Hello friends, this is Raj Sastry from Raj Option Trading. Today is May 14, 2022. Hope you're all doing well. In today's segment, we'll take a look at one of my favorite option buying strategies. It's buying put options. Buying put options is a bearish strategy. You can make money as the stock market declines big time. So one of my favorite way to make money is to look at stocks which are going higher very quickly and very fast. For example, HR Block stock went up very quickly. It's above its 52-week high. So that's when I start initiating some put options and buy some put options and take advantage of stock fading away from the current high stock price. So with that, let's jump in and take a look at the strategy here and see how we can make money with the stock market going down. Especially I love using this strategy for money losing high valuation stocks. Let's jump in and get started. So you might wonder, what is this buying long put or buying a put option? Some people call it as a long put because you're buying a put option. So typically buying a put option is a bearish strategy. Look, you want stock to go down. As the stock goes down, you make money. It's a bearish strategy and a lot of people make money with this strategy. And the loss is limited because you pay a premium for buying put option. The maximum loss is the premium that you paid. That's why limited loss potential. That's why most people gravitate towards buying put option. And profit is unlimited. As the stock market comes down crashing, you kind of make money. So that's why profit is unlimited here. That's why a lot of people love this strategy, where there is a unlimited loss and unlimited profit potential. So with that, let's jump in and take a look at this strategy and see if it's worth taking this strategy and utilizing this strategy. So with that, let's jump in here. All right, so you might wonder, what is this buying put option all about? What's the craze? Why should I do it? Look, here we got an example here. We got a stock here. Stock is at about $40 right now. $40 is current price, as you can see here. Stock is at $40 right now, and you don't have a good feeling about this stock. You think, you know what, this stock, I'm not having a good feeling. This is a money losing company, and stock does not have a good profit margin. And you think stock has gone up very quickly from $30 to $40 in say 2 weeks time or a week's time. So you're not confident, and stock is also bumping against its resistance level. So you decide to say, what, I'm going to buy a put option at a strike price at about $50, which is $10 away or higher than the current stock price. So your thought process is to buy this put option. And as the stock comes down, look, as the stock comes down all the way to zero, you make money. So you buy the put option here at $50 strike price, and for buying that put option, you basically pay $2. So that makes your break-even price at $48. You bought a put option for the strike price 50, you paid $2. So if the stock goes below $48, that's 50 minus 2, then you start making money. Look, this is your profit zone as indicated here, all the way from $48, all the way as it goes down here, you start making money. That's your profit zone here. You want stock to go down. So that's why, it's one of the good strategy here. A lot of stocks, as you know, it's, especially these days, it's hard to make money by owning the stocks. That's one of the reasons a lot of people gravitate towards put option, because as the stock falls down here, you will start making money, and you will start making big time money, as you can see here. And your break-even point is $48 because you paid $2, and current stock price is at 50. As the stock comes below and it goes below $48, you'll start incurring profit, and big time profit. And look, as the stock goes down, your profit start going higher, higher. Look, stop profit goes higher, higher as stock goes down. That's the benefit of this whole strategy here. And look, your maximum profit is going to be 4,800 in this case, because the strike price is $50 and you paid $2. That's a $48 break even. $48 times 100, as the stock comes to all the way to $0, you'll make your $4,800. That's the maximum profit potential. So that's the benefit of buying this put option, and you can do good money here. And as you see here, it's a limited loss, because your loss is just going to the money that you paid. Look here, the loss is going to be just $200. That's your maximum loss. You cannot lose more than $200. Even if this company gets acquired by another company, say Microsoft bought this company, stock shot up from 50 to say $1,000, and still you don't lose more than $200. $200 is the premium that you paid. That's the maximum you can lose. On the other hand, if the stock goes down here, then you'll make big money. Maximum profit is $4,800, as you can see here. And that's the craze about this here. So you got it's a limited loss and unlimited profit, and your outlook is bearish. Look, right now what's going on, you got Fed breathing down our neck. They want to increase the rates, and you got Russia Ukraine war worries, high inflation, a lot of bearish sentiment in the market. This is when you can look at some of the stocks that have gone up so quickly in say a week or two, and right now they're almost at 52-week high, and momentum is fading away slowly, and they're bumping into a resistance level and not cutting it through the resistance level, and fundamentals are not great. For example, the company is not making money, they are losing money, free cash flow is negative. That's when you look at such names here, adopt this strategy and make money as the stock goes all the way from your strike price to zero. And normally what I do is, really, when the stock is at say it's at $40, that's the current price, I go a little higher. I go maybe say $50 in this case here, and then I buy put option little higher, so that way as the stock comes down I make money. So this is one of the good strategy you could adopt this strategy. Many times it's a good strategy. There are some do's and don'ts that we will talk about, but in general, look at the trend in the market. When the trend is going higher, you buy call options. When the trend is going lower, you basically identify good stock, then basically follow this buying put option strategy. You can make some good amount of money. All right, now let's jump in here and look at some more details about this long put option. So you might wonder, what is this long put option all about? So when you are buying a put option, that will give you the right to sell the stock at a price which is known as strike price before certain date. We call it expiration date. So that's the reason here. When the stock is at $40 in our previous example, we bought the put option at a strike price $50. So because we bought the stock at a strike price $50, you can put or sell this stock to somebody at $50, even though stock has gone down to $0, and pocketing the nice money here. That's the benefit here. And it's also a little bit conservative compared to short selling strategy. I also love short selling strategy. This one is a little conservative compared to short selling. We'll compare this strategy to short selling in a minute as we go into the next slide here. All right, from an outlook perspective, you have bearish outlook here. You make money as the stock drops. That's one of the big benefits here. Right now outlook is bearish here. That's why you should implement some bearish strategy, especially for the stocks which has gone up so quickly and not too much great fundamentals to back it up. and your risk is limited to the premium paid, so you're not going to risk more money. It's just the premium paid, and your profit potential is unlimited. As the stock falls all the way to zero, you make money. I mean, in a way it's limited, but it's a good profit potential. And you might wonder, when do I buy? So you buy when the volatility is relatively low, and you should if the volatility is high, like right now volatility is also high in the stock market, and you could consider buying the put spread. That way it balances out. You're buying a put and selling a put. It's a put spread that will balance out. So when the volatility is super high, I go for put spread. I buy some put spread. But if the volatility is relatively low, I buy a single leg put option, so that way there is more money to be made there. And normally, when I buy single leg put option or just a single put option, I look for implied volatility less than 40, so that way I don't pay too much option premium. That's what I look for. And I also look at the stocks which have gone up recently so quickly, and relative strength index is more than 55. That indicates stock is going into overbought territory. That's when I initiate a put option buying strategy. And I also make sure the fundamentals are not super great. Things like negative cash flow, negative profit margin, high valuation, especially price to sales multiple is more than 10. Those are some of the things I look for when I initiate a long put option or a put buying strategy. And from a strike selection, you might wonder, what strike should I select? Stock is right now it's at $40. What strike should I select? If you're a conservative investor or a trader, you have to go beyond the current stock price and look at delta 70. So to understand delta is a coin toss or a probability. If the stock is at $40, you can say coin toss. It can go above 40 or below 40. The chance is 50%. That's where the current price, the delta is typically hovers around 50%. That's why it's a really coin toss. But as you go above the current stock price, then the delta becomes higher, because there is a chance the stock may go below that price. That's why delta goes higher. So if you're a conservative investor and buyer, look at the strike price above the current price, typically delta more than 70 or so. If you're an aggressive trader and investor, you can basically go slightly below the current price, and then select the strike price. So delta is less than 50. 50 is the current price. Delta is typically 50, but you're aggressive. You're going below the current stock price, and you're buying put options below the current stock price. If you're a moderate type person, you don't want to take too much risk, then you can go and basically buy put option at the current stock price. Typically delta is 50 at that level. But if you're a day trader, as an example, you go beyond, you go basically above 80 or so, so that way you go well above the current stock price, and you basically buy put options, so that way you can make some quick money as the stock drops. Typically day traders who want quick profit, they end up going into a little bit higher delta, higher price than the current stock price, so that way you make money as the stock drops. So that's what many day traders love to do. And from an expiration perspective, I would recommend going at least 90 days to expiration, so you got some good amount of time. Because when you buy a put option, or when you buy an option in general, the passage of time is your enemy. So that's why you want to give yourself enough time. I say at least give you 90 days of time, so that way you got some time to be right. And managing the position is very important. When the put option increases in value, basically put option will increase in value as the underlying asset falls in price, or the volatility increases. So that's when you make some money. So as the put options lose value, as the put option increases in value, as you get to your profitability to be more than 50%, I say take some money off the table here and basically record some profit. And put options also lose value as the underlying asset increases in price or volatility decreases. You might you might lose money. That's why you got to be a little bit careful here and manage the position accordingly. And if you when you have a loss, you could close the position or roll into a future expiration date, or you could sell a put option at a lower strike price. These are various options available to you. That's one of the reasons I like options, because there are a lot many options. As you can see here, you could close the position, roll, or you could even sell a lower strike put option and make some money that way. I know a lot of people who who buy put options for at least 90 days to expiration, and basically make some money by selling put options at a lower price, lower strike against that bought put option. So that's one of the strategy here. You buy long put option with the expiration at least 90 days or more, and then you keep selling put options with the lower expiration, so that way you make some good amount of money that will compensate for that will make your the cost basis go down. All right, now let's jump in here and look at do's and don'ts. My favorite time to sell buy put options is when the stock has gone up very quickly and relative strength index is more than 55. And right now stock is showing some signs of consolidation and momentum is fading away. That's when I jump in and start buying some put options. And also stock is bumping into the resistance level here, and it's not cutting through the resistance. So that's when you understand that the momentum is waning away and you could initiate. And typically if you're just buying one single put option, you want to make sure volatility is low. But when the volatility is high, you could go after a put spread and buy a put spread instead. That way it compensates, because you're buying one and selling one. So it's a nice put spread. You could use that when the volatility is high, but when the volatility is low, you could just buy a put option. And when the stock is in a volatility compression zone, typically when the stock goes higher, for example, you got a stock which is going higher, then you see it gets a little bit compression zone. It stays stagnant for a while. Typically next leg is down, so that's when we call it a volatility compression zone. So when it stays stagnant for a while, then it's not making its headway, and that's when you start buying some put option in that volatility compression zone. Next leg could be lower. All right, and also when you buy put options, make sure the company does not have a great fundamental. The sales growth is not great. Maybe there is a negative cash flow and negative profit margin. So make sure fundamentals are not great, so that way there is more probability of you making money. And you do not buy the stock option when stock is shooting higher. There is no sign of waning or fading momentum. That's when you wait for the momentum to fade and don't jump in right away. And if there is a takeover bid, it's not worth your time. Don't buy put option, because there is a takeover bid. Stock is not going to come down. And also you could look at if the insiders are buying a lot of their own stock, or even institutions are buying, then it's not worth your time here. Don't go buy put option at that time. Instead, look at better candidates. And if the fundamentals are strong, don't go after it. Look at weaker candidates here. There are a lot of weak stocks in this market. You could go after those and buy put options. And typically I would avoid the dividend paying stocks, because the dividend paying stocks, typically some of them don't move too much, so that's why it's not worth your time. So go after better ones which are not non-dividend paying. You will do much better in those scenarios. All right, now let's jump in here and look at comparing shorting a stock versus buying put option. One of my favorite strategies to short the stocks, especially in these type of market conditions. When I short the stock, I make sure I have two accounts open. One account I initiate the short, basically I short the stock. In another account I make sure I do have a long position in the same stock, so that way when the stock is at super high level, for example it went up and up, I basically short it. When the stock goes low, I basically have one more account where I have long stock, so that way it compensates. I'm not too much overly exposing myself. And sometimes when I short the stock, I also might buy some call options, so that way I don't burn myself if the stock shoots higher. So those are some precautions you should take if you are shorting the stock. That way you don't get burnt out. So with the shorting stock, this is where we compare the shorting the stock versus buying a put option. So when you short the stock, your profit potential, your loss potential is unlimited. You could lose your shirt. Example, stock gets a takeover bid, you could lose your shirt. This is why I always recommend either buying a call option when the stock is at a lower price, or even buy the stock in a different account, so that way you have a long short type strategy here. You don't overexpose yourself, but if you follow those methodologies, you will do very well. Otherwise, if you don't want to follow those methodologies, then your best option is to buy a put option. You don't need to worry. The loss is limited to the premium you paid. That's why many people gravitate towards buying put option, because you don't need to do too much precaution here. You got to make sure volatility is relatively low, and then you buy put option. Or if the volatility is high, you buy a put spread instead of a single put option. And potential profit is unlimited. This is one reason many people love doing the short, basically short selling. Your profit is unlimited. You'll start generating the profit as the stock declines below your short price. So that's why a lot of people love shorting the stock outright, especially all these money losing companies. And if they go up like 20%, 30% in a day or two, you can always short it. As it fades away, you make good money. And if you're buying a put option here, your maximum profit potential is unlimited. As you can see here, you can start generating the money as the stock goes below your strike price. All right, now let's talk about the borrowing cost here. Let's just say strike price here. From a borrowing cost perspective, if you're a short seller, you do have a borrowing cost, as you can see here. So you got to make sure you will end up paying the broker a borrowing cost here. Look, that's one of the reasons many people don't like shorting the stock outright, because if you short the stock outright right here, you will basically pay a interest amount to your broker for borrowing the stock here. In case of put option buying, you don't need to worry about borrowing cost here. You can just buy put option and be done with it. And if you basically short a dividend paying stock, this is one thing many people know very well. You will end up paying the dividend to the broker whenever there is a dividend cycle coming for the stock. That's why you got to be careful here. If you have a high dividend paying stock and you short it, you will end up paying the dividend to the broker, which is not fun. If you bought a put option, you don't need to worry here. There is nothing like paying dividend to the broker here. So, but still, I would avoid dividend paying stocks if you're buying put option. Not a great idea. And you don't need to worry about whether the stock is optionable or not. If you're shorting the stock, you can short any stock as long as it's available. But if you're buying a put option, you got to make sure stock is optionable. Only then you can buy the put option. That's one thing to keep in mind. And from a time perspective, if you're shorting, you got unlimited amount of time. You don't need to worry. There is no expiration date. You're basically shorting the stock. Whereas if you're buying a put option, you got to look at the option expiration date. After the expiration date, you don't have any right. Your right expires. So that's why a lot of people love shorting the stock, because there is no time limit here. You can keep holding your short position for a long time, as long as you wish. You don't need to worry about passage of time here. There is no theta decay if you're shorting the stock, but if you're buying a put option, you got to worry about the theta decay as the time passes away. It's your enemy, especially when the stock price is above your put strike price. So these are some comparison between shorting the stock versus buying put option. I do both of these things. I typically love doing both, but normally if I'm doing a shorting the stock here, I take some precaution, having a one more account where I hold the stock a long time, or I buy some call options so that way I don't overexpose. You don't have those, you don't need to take those precautions if you're buying a call option. That's one of the if you're buying a put option, that's the benefit of buying put option. All right, now let's jump in here, and you might wonder what I'm ready right now, what stocks I should start buying put options. Here I got few examples here. You could take a look at these here and go from there. Look, all these stocks, as you can see here, look here, in a 5-day time frame, they've gone up so much, and some of them look H&R block here, HRB has gone up so much so quickly here. Look, it's gone up so quickly here. And then we got here one more right here, SLVM. Look, it's gone up so quickly here. And also, as you look through here, look at how much stock is off of its 52-week high. All these stocks are hugging near its 52-week high, and some of them have gone above the 52-week high. Look, H&R block here, HRB, it's 6% above its 52-week high, and SLVM is 5% above its 52-week high. And as you look through some of the fundamentals here, look at the free cash flow here. H&R block, free cash flow negative. Companies really not making it. They're losing money from a free cash flow perspective. And we got a few more here. You got this HURN here. Look, not HURN, the next one here. Dino is again free cash flow negative. So many of these stocks, as you can see here, free cash flow negative, including the one right here, Ingredient, it's a free cash flow negative, and the one next to it, SWX, free cash flow negative. So many of these stocks have got free cash flow negative. I will also avoid the overall score, maybe more than 70. I would not do buy put option strategy too much, but if it is less than say 70, you could approach and do put option strategies. Some of these stocks have got very low overall score, like Go as an example, grocery outlet. Look, overall score is 38, and SLVM overall score is even lower, 21. Those are the ideal candidates for you to buy some put option, or even if you want, you could even short those names here. So those are some examples here. You could take a look at those here. In this one here, look, net margin perspective, looks like many of these companies have got net margin positive, with the exception of Noble Energy here. This one may be paying a good dividend also. You got to be careful with such names here. All right, now what we'll do is we'll look at one stock, go to Thinkorswim platform here, and see how to do buy put option here. All right, so let's jump in here into Thinkorswim platform from TD Ameritrade. Look, we got HRB here, H&R block. Look at H&R block. Look what's going on here. Look, stock has shot up so nicely here. Look at the jump in last say 3 days here. It's gone up so quickly. I think they had an earnings announcement. After that, its stock went higher. I got the Bollinger Band here. Now it's squarely going above its Bollinger Band, and see one piercing through and going over the Bollinger Band here. That's when I kind of think through and see what's the best way to do here. And as you look through here, let's go into one more chart, a different chart, and look at the stock here. So let's go into this smaller chart here with a little more technical indicators. I'll bring in HRB here. All right, look at H&R block. Look, it went higher. One more, higher again. Earnings happened. After the earnings, it went higher. So that's one of the reasons stocks like this are intriguing for you to buy some put options. And look, we got, let's see here. Look, from a momentum perspective, right now momentum is going higher. That's why RSI is jumping higher. And IV percentile is going down here, especially after the earnings. Implied volatility comes down. Right now it's 71, but it's trending down, as you can see here. Right now looks like DMI perspective, there is a bullish. It went through so quickly, that's why the blue line is going above the red line. It's bullish right now. People are buying the stock here, but look, volume is slightly coming down here. It had a nice two big candles. Now it's going down slightly. The third candle here is slightly weaker here, and smart money looks like it's going in here. That typically happens when the stock goes higher. Probably now it's the time when some smart money will start pulling out. So this is when I jump in here. And you might wonder, how else I could find out about these stocks where I can do some put option buying. So we'll go into that in a bit here. So now you found the stock. Sorry, let's go into HRB here. I think it is HRB. Yeah, I think we're looking at HRB here. Now you might wonder, okay, how do I buy put option? You can go to option chain here in your brokerage platform. This one is Thinkorswim here. Stock price, as you can see here, is $32 right now. All-time high, 52-week highs again at the 32.36. We're almost hitting the 52-week high here. And you could look at the strike selection here. From a strike selection perspective, current strike is 32. Look, we are at right here, $32. Right here, we are at $32. So at $32, as you can see here, from a delta perspective, it's 46, which is middle of the road here. It's a coin toss right now. But if you want to buy put options, I say you can go a little higher. Look, we could go right here. At say right here, look, $37 is the price here. At $37, as you see here, we got delta about 79. So at delta 79 tells you there's a chance that stock can go lower from this level here, and chance of the price going to this 37 is very low here. 34% chance the price will go into $37 by 15th of July. We got about 62 days to expiration here. And as you scan through here, one more thing people always look at is open position here. Look at the open interest at $33 strike price here. We got 25 open interest. So since there is some open interest, you could go after this here at $33, which is slightly above the current price. Delta is about 54 here. Or you could look at one more selection here, 35. At 35 also you got 4 open interest here. You could do that too here. Delta is slightly higher, and you're paying just about $3.90 or so. So with that, I say, if you're a little bit aggressive trader and investor, you could go after right here. There's a good open interest here. You could go here and buy put option. Look, we are buying a put option here for HNR block, and expiration date is 62 days out, 15th of July. We are buying a put option, and we are paying $2.45. And look, there is a mid price, and there is a natural. So typically what I do is I put the mid price here. It's 230. I could say, because I'm paying money here, instead of paying 245, I could even reduce slightly here. I typically make it maybe 240. You normally get a fill and just confirm and send. Look, right now we are paying $2 and we are paying $2.40 to buy a put option for HNR block at a strike price of 33, which is above the current price here. So our maximum loss is the money that we are paying right now. That's $240. And if the stock comes down all the way, we make money. So that's the advantage of buying put option. If the stock comes down here from 32 to say 25 or even 20, you start making good amount of money. And because you're paying here $2.40 here, you want to make sure it at least goes below $2.40 off of your strike price here for you to break even. So that's why you got to wait slightly, make sure stock comes down. If it comes down quickly, you'll make some good amount of money. So this is one better way to buy put options. One of the good strategy I always implement, especially when the market is trending lower, you should follow the trend and initiate some strategy like this here. One thing traders always gets sidetracked is they will have one or two strategies and they will always follow them, which is not great. You got to look at the trend. If the trend is up, you could go after the call buying strategies. If the trend is down, go after put buying strategies, so that way you're not exposing yourself. And let's suppose you're not too confident, you think IV percentile is super high here, you don't want to buy a individual put option, you could also do a put spread here. If you want to do a put spread here, you do probably a in-out type spread here. You could buy 35 and you could sell 30, something along those lines here. You could go here and you could just buy a put spread here, right there, vertical. So you're buying, you're buying 35 and you're selling at 30. It's a $5 wide spread here. You don't want to speculate too much, that's why you're doing this. And you're paying here $2.70, as you can see here, for this $5 wide spread. And if you confirm and send here, your maximum profit is $2.30. Your maximum loss is $2.70. That's the money that you're paying. So this is another strategy where you don't quite double your money, but you make some money if the stock falls. It's a limited profitability, or a limited, or a cap. There's a cap for the profit you make. This is one strategy a lot of people follow, which is a spread trading type strategy here. So it's a little you don't make too much money, but it's a little more conservative strategy. It also helps you when the volatility is super high, because you're buying one and selling other, so it'll compensate for the premium that you pay when the volatility is high. All right, so let's jump in here. And you might wonder, how do I look for these stocks? Where do I get these type of stocks? So one thing I always look at is one of my favorite platform, which is Finviz. So as you go into Finviz platform, which is one of the great platform, I love this, I'll tell you why. So if you go to Finviz platform here, look, you can in a nutshell here, you can find out what's trading higher. So as you look through here, I see here, look, there is also new high. I look at this new high list very closely. Look, we got few stocks here. SVM. If you click on SVM, this platform Finviz, it tells me how the stock is looking at. Look, it has a small chart here. In this chart, I can see here SLVM has gone up so quickly. Look, in a couple of days, it's gone up so much. And I could also click on this and look, it's got a nice looking chart here. Stock has come down nicely, now went up so quickly, as you can see here. And as you scan through here, you could look at the company here. From a sales perspective, I don't see too much going on here. Slightly higher, but still down from previous high. Shares outstanding, no biggie here. As you can get a good idea about the fundamentals here. Look, there is a profit margin here. Net margin is 9%. But when the stock goes high, you could take advantage. And you could also see if the stock pays dividend. Look, there is no dividend here. You don't need to worry. So you could take advantage here. As you look through here, you could also look at the relative strength index, or RSI. Look, RSI is 67. That's a little bit higher. So you could identify such stocks through this Finviz platform, especially by looking at this new high list here. When the stock is hitting a new high, or even a top gainer, you could look at this top gainer list also. Look at names like Veru. Veru has shot up here. And look at AMRS. AMRS, I would not go here. It's just slightly higher, very low price stock here. Typically, even Duolingo for that matter has gone up so much here. I could look at such names which have gone up so quickly. There's a big gap. I could initiate a fading strategy by buying the put option, or even buying the put spread here. All right, so with that, let's jump in here, go back. So with that, you might wonder, what should I do now? I got a lot of information overload. What should I do? So what you could do is, really, if you're an investor and a trader and you want to benefit from stock market going down with all the uncertainty here, and you want to benefit from a stock going down here, you could buy put option or even a put spread if you want to, and take advantage of market going down. So one of my favorite ways, really, when the stock market jumps up, this is really, we call it a bear market rally. When the stock goes down a couple of days, goes down, and then jumps higher higher, maybe 1,000 points. That's why you can you can go after the stocks that shot up so quickly, and you could buy some put option and do the fading. Typically, when the stock market goes up very quickly, those stocks will have a little bit lower volatility, and you could start initiating put buying strategy there. And then watch, you bought the put option at a strike price. As the stock goes down, you make money. That's a good feeling. And when do you want to buy put options, you might wonder. So you buy the put option, you basically buy the put option when there is a low IV percentile. That's when you have a little bit, you don't pay too much option premium. So as you can see here, when the IV percentile is relatively low, you buy put option. And you also make sure the relative strength index, or RSI, is more than 55. That tells you stock has gone up so quickly. That's why relative strength index is high. And it will be good if you can also make sure stock is losing some momentum now. It's gone up so quickly, it's losing some momentum, and fundamentals are not great. That's when you start initiating the put option buying strategy. From a stock perspective, I could look at the stocks that we talked about. You could look at H&R Block. You could look at the other stock, which is SV right here, SLVM. Those are the good ones here. You could also go after Go. These are the good candidates here. They've gone up so quickly. As you can see here, you could initiate put buying strategy in such stocks here. All right, so with that, thank you very much. Happy investing and trading. Please subscribe.